Security-backed lending, top secret tax advantage of the wealthy 1%ers. What is security-backed lending? Who's eligible? How do you use it? And who do you need to contact? Well, that's what I'm talking about in today's video, and I am ready to blow your mind. What's up, YouTube? My name is Nicole Bowdle, local real estate agent in Park City, Utah with Berkshire Hathaway Home Services. If you're new to my channel, I drop new videos every single week helping buyers, sellers, investors, as well as providing local insights on the Park City area, what it's like to live, work, and play here, and the surrounding areas of Park City, Utah. So what is security-backed lending? Well, it is getting a loan using your securities. It is like taking out a line of credit on your investment account. It is not a margin loan, it is not a taxable event, and it is not a lien on your property. Using your stock, your investment accounts as collateral to take out a line of credit. You cannot use your 401k and you cannot use your IRA for this. That is a totally different video, a separate entity, and there's a way to do it, but it has different provisions, and that's not what I'm talking about in today's video. This does not require an income check. It does not require a credit check. There's no lenders, there's no underwriting, and there is no appraisal. It operates similar to a HELOC, a home equity line of credit taken out on your home, only it's a line of credit taken out on your investments. You have no monthly payment, and you have no set time frame that you have to pay this line of credit back, just an annual review every year saying, here's what you owe, here's your interest. Obviously, the higher the risk, the lower the amount of money they're going to lend you. The lower the risk, the more money they will lend you. Typically, they'll lend you anywhere from 65 to 70% of your portfolio value. You need to borrow at least 100 grand. So this is for people who have well-established investment accounts, who are probably high net worth individuals, and you invest in the stock market. It's your stocks, it's your bonds, it's your mutual funds, it's your investment accounts. You don't lose any of your portfolio investments. That stays in your account, it continues to grow, you continue to earn on it, you continue to collect dividends. All it is taking a line of credit out on that account. You're basically just borrowing against your collateral, and in this case, your collateral is not your home, your collateral is your stocks, bonds, and mutual funds. You now have cash in your hand to go buy whatever you want that you couldn't get financing for, or you didn't want to go the traditional financing route because you didn't want to deal with lenders, appraisers, and underwriters. The amount that you're able to borrow on your portfolio varies because it depends on what your portfolio consists of. Each stock has a different risk value to it. So who is this for? It is for investors, business owners. If you're purchasing a second home, if you are a real estate investor and you buy multiple properties, if you're buying commercial land, if you want to fix up your basement, enhance your backyard, do a complete renovation, buy a car, buy a plane, buy a private jet, buy a yacht, whatever it is you want to buy, you can buy with this money. They don't care. You could even pay your taxes with it every year. It is great for hard money lenders, and it is great for people that are high net worth individuals because it has many tax advantages. If you are buying and selling a lot of real estate, you know you have to pay capital gains on that unless you're doing a 1031 exchange. Well, guess what? This could be a tax loophole for you. So how do you use it? Well, it acts like cash. There's no appraisal, no underwriting, and no lender to deal with. So who do you need to get into contact with? Well, there's actually only 4 companies that do security-backed lending. One is Merrill Lynch, the second is Morgan Stanley, the third is USB, which is a very small company, and the fourth is another small company, Soltis Capital. So if your investment account is with Charles Schwab, Fidelity, and you go to them and you say you want to do this, guess what they're going to put you in? They're going to put you in a marginal loan. You don't want that. It's riskier and it has 10 times the interest. So what you have to do is you actually have to move your money from Charles Schwab or wherever it is and put it with one of the 4 companies that I just described. You need to hire a fiduciary, a wealth manager, somebody to run your portfolio, to look over this, to be at the driver's seat at all times and make sure that nothing funky is going on here because you're taking out a line of credit against your stocks, which are in the stock market, and the stock market is volatile. It goes up and down, and you need somebody to be watching over this for you so that you don't over leverage yourself and get into trouble. I know what you're thinking. it's too good to be true. Why didn't my attorney tell me about this? Why didn't my CPA tell me about this? Well, I am going to put a link below that you are going to want to click on and read all about. Send it to your CPA, send it to your attorney. You're going to come back and be like, why didn't you tell me about this sooner? And you're going to be really happy. So you need to check out something called the Securities Act of 1934, and it is the Federal Reserve Board Regulation Section 220.